We haven't even started talking, and I have like a big smile on my face because it's going to be so good.
Yeah.
Yeah, thank you for doing this and for like taking time out of your busy schedule to be here and just like talk about the stuff that people don't really have access to. And I know
Yeah,
that you're all about access. You're all about like disseminating information and empowering people with that information. So, yeah, so excited for the people who are listening right now.
I'm excited to be here. Thank you so much for having me. It's just an honor to be able to have the conversation and to be asked to have the conversation. So thank you, Isha.
Yeah. So I really want to use this time to cut through so much of the contradictory advice that is out there from, the well-known financial gurus, um, and really looking into like some of the secrets, some of the secrets of the wealthy, some of the ways to use life insurance in particular, um, to grow money, to protect money, the stuff that like just really speaking to the objections people have or the stereotypes people have. Um, let's talk about what keeps people from getting started in investing. What are
Yeah,
the fears that come up for people? And what is the impact of the delay when people don't invest? Like what happens? Because I know that
absolutely.
you're big on that.
Huge on that. Huge on that. I mean, I think for a lot of people, it's first of all life, right? It happens.
Yes.
And it's just natural when life is happening for us to put things on the back burner. And namely, what we usually end up putting on the back burner is ourselves, right? Uh,
Yes.
we, pay all the debts. We're, doing things for our kids. We're, doing things for the household. And, a lot of times what ends up happening when you're not really kind of understanding the number one rule that the wealthy understand, which is that they literally will always pay themselves first. Like they're their first bill that they pay, right? It is clockwork for them. And what I will tell you is that's really like I think one of the more important things is really like scheduling yourself at the top of the
Yeah.
pay list, right? And the reason you want to do that is because you really are not going to have the opportunity to build any level of wealth unless like you understand compound interest. And
Mhm.
like compound interest and the rule of 72 is really the most important, I think, rule you want to understand if you're going to talk about building wealth. And the only way that that works is if you allow time to do its work, right?
Mhm.
All
Mhm.
limited amounts of time. But if you don't literally build this muscle of paying yourself first, being patient, and letting your wealth actually work for you, letting your money work for you through time and through like getting a decent amount of interest on your money, there's
Yeah.
no way that you're going to accumulate wealth. So one of the things people do all the time, and I know you've heard this, Isha, I hear this, is, oh my God, I have all of this debt. I need to pay this debt off first and then I'll save.
Yes.
And like,
Yes.
that's super understandable, right? Like no one wants the anchor around their neck of debt. And you
Hmm.
pay your debt off. That's something you want to do. But what I will tell you is that with whatever it is that you're paying towards your debt, still find a little money to put aside for yourself and pay your debts. Like that's the most important thing. Because if you don't, you're just going to keep on repeating this cycle. Because the reason you might be in debt is because you had an emergency come up, right? And
Right.
maybe
There's always something.
it's always something that comes up. But if
Yeah.
you have, a safety net, if you have a little emergency fund that you put aside, then that can keep you from repeating that cycle of going into debt, right? Debt is obviously like a huge, huge enemy to your wealth, but you really kind of want to be going at both of those things at the same time, right?
Yeah. And I think that it's something that's something that often gets in the way for people is thinking that they need to have like some lump sum available to invest. That's a huge barrier for people, like just like a mental barrier. And it's like, no, you can like put $50 somewhere, right?
You
Like,
can.
yeah, and just start small, but start doing it. Start, like you said, building that muscle of consistency and just doing like the repetitive, boring things
Mm-hmm.
that often get underestimated that wealthy people do.
Yeah.
Yeah.
Yeah. No, I mean, and you would be shocked. Literally, like that $50 that you're putting aside, that will build up. Like you will be shocked at what it builds up to. And a lot of times, people are like, well, $50, like that's not going to be anything. Well, it will be a lot harder if you're doing it in a traditional savings account, right? If we're doing
Yes.
it at, like a traditional savings account, a traditional bank, I don't want to throw any names out there, but we all see them every single day. If they're paying you 0.01, 0.03, 0.0 nothing, then it'll be a lot harder.
Yeah.
But if you are putting aside $50 a month and you're doing it in a high yield savings account where you're making 4%, 5% interest, that can build up to be easily a few
Yeah.
$1,000s, right, over a couple of
Absolutely.
years. And it's just starting that muscle, building that muscle. And it just, that in itself, I think psychologically starts to make you feel good. Like when
Yeah.
you're putting aside something for yourself, right? If you can put it on like an auto deposit, even better, so that you don't have to think about it. It's just a muscle and it just goes, right?
Yeah.
Um, and there's so many things that we might spend money on that like we don't even think about, right? Like if you're doing DoorDash, or you're going to the store and just buying like, I don't know, like cosmetics or whatever it is, right? That kind of, some of that money sometimes goes and we don't know where it's going, but it's happening because we're not like paying attention to it.
Yes.
You really almost want to put your money in a mode where that paying yourself is you not paying attention to it. Like literally, like if I can have that automatically deducted from my account and I know it's trickling, and I even forget that it's happening, right?
Yeah.
You want to put yourself in that mode. And for some people, that might be their 401k, right? That might be your way of paying yourself first. And that's okay too. As long as you're actually doing it, as long as you're doing something that regularly is going to be paying you, that already puts you like well ahead of the game.
Hmm.
Well ahead of the game. So yeah, I think you're 1000% right. A lot of times people do think that you have to like start saving, larger sums of money. And that is, again, a big mistake to think that way. And I think the financial industry as a whole has gotten people thinking that way, just because most of the time, just to even get advice on what to do with your money, most of these companies will not talk to you unless you do have lump sums of money to put away, right?
Exactly,
So
exactly. So we've been trained to think about like, yes, even seeing a financial advisor, it's like, well, I don't have any money, but it's like you can start that small.
you can
Yeah.
start that small. You can
Yes.
absolutely start that small. There's all sorts of even robo investors that will allow you to save like, $10 a month into an account, so
Yeah.
you can start really, really small. It doesn't have to be a lump sum.
Yeah.
Yeah.
And the other piece that I was thinking about, like when I see my, my insurance premiums, right? Because of cash value life insurance, when I see those premiums coming out of my account, like I feel really good. Like it is a chunk of money, and I feel really good when it's leaving my account
Yeah,
because I know where it's going.
it
You
is.
know, for me, it's like, yes, there is a subtraction happening in my account, but the subtraction is an addition to my future self.
It really, really is, right? It really
Yeah.
is. It's like it is one of those things that it feels like a subtraction up front, but it's really gonna pay over and over, and
Yes.
compound and grow and be tax free, and that's gonna be huge, at the
Yeah.
end.
And I think some people think of it as like, you know, especially when we're talking about cash value life insurance, which we're going to talk about more in a minute. People think about these premiums as payments, right?
Right.
They think that they're paying the insurance company, but really, yes, there is a portion of that payment that's going towards the cost of the insurance, but then there is what you are putting in for yourself. And it's
Yeah.
like, I don't think of it as a payment. I think of it as like paying myself, right? That's exactly what we're talking about when we talk about paying ourselves first.
That's exactly what you're talking about. And really the bigger portion of what you're paying into that is going to paying yourself.
Yeah.
A properly designed policy, and I know yours is properly designed. You should properly design policy, literally a fraction of what you're putting into the policy is going to cost of insurance.
Mm-hmm.
So, that means that the bigger bulk of that money is being put to work for you, for your future, and I guess for me, again, the beauty about that is you're not having to wait, necessarily until retirement to access that money, right? If you needed to
Yeah.
access that money, you could absolutely access it much sooner than you could, in a lot of other accounts. But, you have again a nest egg that you're putting aside for the future that can be used, for obviously retirement, for long-term care needs, for building generational wealth for your family. So there's so many different purposes that you're kind of putting that money aside for sure.
Yeah. And so when we think about, when we talk about cash value life insurance or IULs, index universal life, or even, they're called financial pocket knives and super Roths, why is it that why is it that people are so suspicious of like the fact that you have access to market gains, but you have protection from market losses? Like that, when I heard that the first time, I was like, what? Like, how
Yeah.
is this possible?
Yeah.
Yeah, so I would just love for you to share, like, why is that? Why is it that life insurance companies can do that? And why is it that we don't know very much about it?
I mean, there's a few reasons behind that. And what I'll tell you is that insurance companies, right, are still a part of the traditional financial industry,
Yeah.
right? And if you're kind of just even looking at some of these guides, right, with some of these major insurance companies, they will tell you that their target market is the affluent or the emerging affluent, or
Um,
or high income executives. So when you're like looking at who they internally market to, they're not marketing to you, me, the average Joe. They're marketing to specific clientele. And this
okay.
clientele, they usually will know all about it, right? 75% of Fortune 500 CEOs having a cash value life insurance policy, right? So they understand it very, very well. When you haven't heard of it, it's literally because it wasn't necessarily designed for us, but it can be used by anybody, right?
Yes,
So even
yes.
though like you have, I know of one of the major companies, their average index universal life premium is over $4,000 a month. Most people are not able to put $4,000 a month into their cash value life insurance, right? That's just a common fact, but that's their average. So that tells you again who their target market is.
Yeah,
However, right, anyone can get the policies. Anyone can take advantage of all of the benefits. And again, just because it hasn't been marketed to us doesn't mean that it's not for us, right? So I think that's the biggest thing. And these policies are also not policies that you can just go online and like apply for,
right. You can't just
right?
get them.
You just can't get them. You do have to work with a financial professional, an insurance specialist, a financial advisor, someone that is aware of how the product works in order to be able to use it, right? So again, it's not something that the general public has been very like made well aware of on just a broad basis. But these policies, I mean, insurance, obviously one of the oldest financial instruments in the world, has literally been around for thousands of years, and it's evolved, dramatically. But specifically, the index universal life policy has been around since 1999. So you literally have 25 years of history. And literally, since it's been around, that market's grown 20% every year, year over year. So there are a lot of people that are learning about the benefits of it. But again, a lot of people are intimidated by it because it is more of a complex instrument. You do want to understand the mechanics behind it. There are designs or, ways that the index universal life policy can be designed that are not great for the consumer, right? So you want to definitely make sure that you're working with someone that is, has values, has ethics, that's a fiduciary, that's going to design it properly and do what's in the best interest of the client, because you can absolutely design these where it's more beneficial, right, for the agent versus the client, which is
Right.
completely incorrect, right? And
Yeah.
so because of that complexity, a lot of people are just turned off they don't even really want to even look at it because out of fear, right? And so again, it's just a matter of understanding, and it's a matter of education and a matter of exposure. Because of the complexity of it, a lot of even, people that deal in insurance, they'd rather deal with term insurance policies because they're simpler. They'd rather deal with whole life insurance policies because they're simpler. They
Ah,
don't necessarily market it, right? So there's
right.
different variables and reasons behind it. But really, when you look at why it is valuable and why it's important to learn about it, is because it just cash value life insurance in itself is a specific asset class that there's literally no other financial asset class that acts like it.
Yeah.
There's not a financial asset class, right, where you can take your money, right, put it inside of a policy if it's indexed, right, put it inside of a policy that's completely protected from market losses, that will be completely tax free, right? As long as you keep that policy in place, you can access the funds tax free. You don't have to pay those funds back into the policy, right? The death benefits tax free, that you can, essentially attach long term care to, which is a huge reason
For
why.
no additional cost.
So you have a cost, you do pay for long term care insurance with it, but it's way cheaper, right? Because you're kind of putting life insurance along with long term care. It's way cheaper than if you were going to do a standalone long term care policy.
Right. Yes.
More benefits. You don't have to worry about your premiums being increased on you like a lot of long term care plans do, right? With long term care insurance, a lot of the times, and again, this is super important. A lot of people overlook this in their financial planning, their financial strategy. And it's hugely important because long-term care is super expensive now. Like anyone that's dealt with their family getting older, or someone being disabled in their family that needs to be in like a qualified care facility, it's super expensive right now. Like crazy averages. Like I think just to have even someone coming in home right now to kind of service you in home can be thousands of dollars.
Totally.
You get ready to retire 20 years, 30 years, 40 years from now with inflation, it's going to be astronomical. And that's why states like, Washington State, they already actually have their citizens paying into like a state ran long-term care plan, because
Really?
they anticipate like how much it's going to be with these huge, generations that are coming along, millennials, bigger generation than baby boomers, right? Gen Xers. So as we start aging, living longer, right? Uh,
Yes.
it's going to become an even bigger problem. And the idea is like, how do I pay for that? How am I going to pay for those types of services? And a lot of times, another reason people are like, well, maybe if I choose not to have kids, or I'm not married, or I don't own a home, what's the purpose of me having, a cash value
Yes.
insurance policy, right? Maybe I only need a burial policy. And it's because you can, number one, build wealth inside that policy tax free, but then you can also attach long term care to that policy and know that you're going to get the benefit of that money one way or the other. If I buy a standalone long term care plan, 70% of us are going to use it if we are over the age of 65, but 30% aren't. So that means I have a 3 out of 10 chance of maybe not needing my long term care. And if I had a standalone long term care plan, that's like car insurance. If I don't use it, I lose it.
Yeah.
Whereas attached to my cash value life insurance, then I'm going to get the benefit of it one way or the other, right?
Exactly.
Whether I get cash value or my family gets the benefit of it. So, there's so many different moving parts to why it makes sense for most people. If you can literally qualify for it, because you obviously, you have to medically qualify for it. If you medically qualify for it, it really is a great thing to have as a part of your portfolio for sure.
Mhm. And one thing that I see a lot is that most people have their retirement savings in tax deferred assets.
Yeah.
Yeah, and it's just like it's such a like a no-brainer to move people in sort of a tax advantaged uh asset class, because it's like people underestimate, in my opinion, people underestimate the impact taxes have on whatever they're saving. They
Yeah.
just kind of like they think of it as a given, and it's just like, okay, well, that's just what happens, without realizing that there are vehicles that they don't pay taxes on, right? When they
Exactly.
start pulling out that money.
No, the tax implications are huge. I mean, I think all of us kind of know the big problem that we have federally with the deficits and how that just keeps on getting higher and higher and higher. And, I don't think that a lot of us are taking into account, how changing legislation could affect, how much we're getting taxed later on. Somebody
Right.
pay for it, right? Someone's going to be paying for this, and that's going to be coming from us. And, maintaining the status quo is really not likely. Like it's going to probably be a situation where we're going to see tax rates go up across the board to pay for it. So when you think about, paying in the future, 35%, 40%, 45% taxes and how that could affect what your 401k looks like. I mean, most people are not under the, they say, okay, well, I'm a 401k millionaire, right? Well, yeah, maybe your 401k balance says $1 million, but when you withdraw that, like really it's more like $700,000, probably at a minimum, right?
Mhm.
Most
Mhm.
people are going to be, right around 30% with federal taxes and state taxes. So you have to work that much harder, to make up for that difference. Really, what you're looking at in your 401k is not what it actually is, because you have to look at today's taxes, let alone tomorrow's taxes.
Right.
And most people think that they're going into a lower tax bracket, when they get older. And that might be the case. But if you've done what you're supposed to do, like
It'll be higher.
be higher or at least the same, right?
Yeah. Yeah.
And so that's really what is scary about it, because it's an unknown. It's something that you can't control. None of us control like the taxes that we're going to pay in the future. You can only control what you can control. And what you can control is how your money grows and where it's growing, right? You can control, like, okay, am I going to be putting the majority of my money into my 401k, or am I going to look at other options? Am I going to look at maxing out my Roth IRA, right? And even your Roth IRA is amazing, but it has limitations, right? I
Hmm.
can only, if I'm under 50, save it like max of $7,000 a year, right? If I'm over 50, I can max save $8,000 a year. For most people and the lifestyle that they're going to want to have, let alone like what inflation is going to dictate that you have to have. Because
Yeah.
like, another thing people don't really pay attention to is inflation, right? And yes, it's supposed to stay around 2 to 3%. And that's what the Federal Reserve has been keeping our rates high for a long time. But who's to say that it does stay at 2 to 3%? And what does that 2 to 3% look like? Because in reality, most of us understand that it feels like much more than that, in a lot of the different things that we pay for. So if you're
Yeah.
not paying attention to taxes and you're not saying, hey, look, let me put my money in a place where I don't even have to worry. It doesn't matter if they raise the tax rate up to 40%, 45%, 50%, because my money's growing in a Roth IRA, or my money's growing in an index universal life insurance policy, or my money I'm saving for my child's college in a 529 plan, or whatever, tax advantage instrument it is. If you're not really like, if you're not focused on or being conscious of where you put your money, you could end up paying a whole lot more, right? Just because you're not paying attention to where and how it's growing.
Yeah. And I mean, it comes back to what you were saying earlier about like, you said something earlier about paying attention like how you're spending money. And I think that that really, it comes down to again, like this presence with your money. This is sort of what I
Yeah.
teach people about like caring for your money, paying attention to your money, like being discerning about where your money goes, where it flows, what you're investing in, and having it be in alignment with your values.
Yes.
Yeah, and so it's like I love that because it brings it back to it just grounds it again. Just
Mhm.
pay attention, be with your money. Be with
Yeah.
your money. And then something that you teach a lot is just like the patience. People, I mean, you tell me, like I find that yes, people tend to want to have things like grow quickly,
Yes.
right? They want it to happen fast.
Yeah.
So yeah, I'd love for you to speak on that.
I mean, we live in a instant gratification world, right? We are all spoiled because we can get what we want when we want, whenever we want, you know, tons of crypto millionaires, right?
Yeah, yeah.
People that have invested, relatively small and have gotten huge gains. And yes, that can happen. Absolutely, that can happen, right? Tried and true, though, I think is probably one of the more reliable things. And what I mean by that is, even if you're thinking about the stock market as a whole,
Yeah.
right? And I know, again, because we're all super emotional creatures on different levels, right? We're emotional when it comes to like, oh my God, like the stock market is crazy right now. Like I need to move my money right away, right? And
Mm,
a lot of trigger reactions when it comes to like our money, right?
yes.
I have clients that I work with, and it can just be like a shaky week, and they're like, is everything okay? And I'm like, a correction, a 1 day correction, a 2 day correction, a week correction, right, is not a trend, doesn't make a trend, right? And these trigger reactions, when we have them, a lot of the times will prevent us from then reaping the gains and the benefits of the amazing days that come right after it.
Yes.
Like I think, and like literally, I think it could have been, it's within the past 30 days, we had one of the worst market days that we've had since 2022. And then literally within the same week, we had one of the best days that we've had. And
Yeah, yeah.
things that happen, right? It's like this. People, I think, again, if we're talking about patience, we're talking about just the tried and true things and learning how not to think micro about investing, but think macro, think
Yeah,
big picture, right? Think
yeah.
30,000 foot view. Because if I run projections from like, literally going back to when they first started actually even tracking the S&P 500, we're talking about like the 20s. One thing that's kind of been predictable is the growth rate. Market's been on average, if you're not working with a professional and you're just investing in index funds, S&P 500 index funds, it grows on average at about 10%
Wow.
with all the ups and downs, right? And a lot of us, like, we remember the 2008 recession, we remember the market crashing and 40% losses, just boom. Some
Yeah,
of us remember the dot-com bubble crash,
yeah,
2000, 2001, 2002. Like literally like from 2000 to 2010, like that decade, there were literally like two major periods really where you could have lost literally over 40% of your money twice,
wow.
right? Huge. So it's like, okay, I came out of the 90s. The 90s were amazing for my money. I go into the 2000s and it's like crap for my money. And then I'm getting out of the market. And then what happened? We had the longest bull run, the longest run of positive growth that we had for like the next decade. And that's what I mean is like patience, not having trigger reactions, right?
Yeah,
And, the tried and true rule is this: if you have patience and you have consistency, you are going to win no matter what, right? If you're investing in the markets 20 years, 30 years, you're going to win no matter what, right? Even with all the ups and downs. Now, how you want to get smart is not having all of your eggs in one basket, being diversified, right? In every
yeah,
way that you can possibly be diversified, being tax diversified, like we were just talking about, having, money that's growing tax advantaged and tax free, money that is growing tax deferred, right? Reason being, maybe you want to get some of those write offs this year, right?
yeah,
Money that you can access right now that you might pay taxes on every year. You might pay dividends on every year, but you want that money liquid and accessible. But diversified also in the different asset classes, right? Diversified into, obviously cash. You'd have some cash on hand. You want to have some cash on hand, but being diversified in places where you're in the markets, but then you might also have some domestic investments. You might have some foreign investments, right?
mm,
You might have some investments into metals. You might have some investments into real estate.
yeah,
You want to be as diversified as you possibly can be, and then also diversified into fixed accounts, right? Accounts that you know what interest rate you're getting. Variable, obviously, that's the markets, but then
yeah,
obviously the index accounts, right? Where you have market protection. And if you have that type of diversification, that allows you a lot of freedom because you're not just having to pull your money from one place, and you can, strategically, access your money, in the appropriate times, right? If I'm in retirement, maybe I don't want to dip into that money that's in the middle of a correction. I want to
yeah,
not fall into my losses, right? I want to wait until
exactly.
it recovers and go to my indexed account or go to my fixed account and pull that money.
Yes.
And like I
Yes.
have those options and I can magnify my wealth and magnify my income if I'm smart and strategic about how I access those funds.
So, okay, so this is great. So we're talking diversification and really spreading ourselves, spreading out the risk, right? Because any investment involves risk, and people
Yeah.
don't like risk, right? They feel unsafe, they don't want to lose money, but there's some instruments that have less risk involved, right?
Right.
But often the question that I get asked is like, oh, but is insurance FDIC,
Yeah.
FDIC insurance, right? And because people trust banks,
Yeah.
but banks are not doing anything for them and are in fact, in my opinion, kind of exploiting people, at least using their money to make more money for themselves.
For themselves, exactly. Like we've been talking about how what they'll pay you literally like a fraction of a fraction.
A
But then
fraction of a fraction.
they'll turn around and like give you a credit card for 20%. They'll turn around and give you a mortgage for 5-6% or higher, right?
Right.
So they are taking your money and leveraging it. And what a lot of people don't realize about banks is we are under a system of what's called fractional reserves, right?
Mm,
Right under a fractional reserve system, which means that literally they don't have to have every single dollar, right, that you put into their system. Like,
yes.
right. So most banks, and it really kind of depends on the bank, but they're anywhere from like 0% to like 20% reserves, meaning that, hey, if I deposit $100, they have to maybe keep $20 at best, and then they can loan out the other $80.
Wow.
Right. So they are risky. And because of that risk, that's why the federal government backs them up, right? That's why they're backed up
Yes.
by FDIC because of this fractional reserve system, so that people can feel, okay, like, you know what, the federal government's backing it up. I can have up to $250,000 in an account. And if this bank fails because of this fractional reserve system or whatever is happening, I know that I'm going to be backed up by the government, $250,000. And
Yeah.
that's great. Thank God for that, right?
Yeah.
Most of the time, we've seen situations where banks have collapsed, the government usually makes people whole immediately.
Yeah.
But really, the reality is the FDIC could take up to 10 years to pay you back
Gosh.
if that happens,
Wow.
right?
Yeah.
That's the reality, not what happens. Most of the time, like I said, the federal government makes people whole pretty quickly, but they don't have to. So if there was a situation where there were collapses to that degree, they would have time to kind of make people whole, right? What a lot of people don't realize when it comes to insurance is insurance companies operate under much, much stricter standards, like way stricter standards.
Then
At,
banks.
yeah, like at the very bare minimum, at the very barest of minimum, an insurance company has to carry $2 for every $1 that they're responsible for, right? That's by law to even be solvent.
Yeah.
Most insurance companies, though, are like 4 to 6 times that. So for every dollar that they're responsible for, they have 4 or 6.
Yeah.
And that's kind of where those ratings, like if you're looking at insurance ratings, A plus, A plus plus, that basically goes to their financial stability, their financial security, right?
Got
So
it.
showing you like, okay, this particular insurance company has way more in assets than they do in like claims that they're responsible for,
Yes.
right? So they operate that way. But again, nothing's infallible, right? So let's say there was an insurance company to go down. Every state has an insurance guarantee association, and every insurance company is kind of paying into this association. And what happens basically if an insurance company were to become insolvent, that's where the state steps in, right? And
Mhm.
they would actually make people whole with their claims, right? They would first try to,
Okay.
make sure that if they could kind of rehabilitate the insurance company, they try to rehabilitate it. But if they're not able to rehabilitate, the state insurance guarantee for each and every single state would shore up the claims in that particular insurance company. So
Okay.
it's not back FDIC, but you absolutely have a much stronger financial standing when it comes to that. And that's a huge reason why the majority of banks invest like billions and billions of dollars themselves into insurance because they're literally like some of the most stable companies that you could
Yeah.
have.
Yes, exactly. And that's what people don't understand is the stability. And how do you, I mean, maybe you know or you don't know this, but how is it that, why do you think that that's what people believe? How did these beliefs develop?
The
Why are we in this place? Yeah.
about the stability of the companies
Just
or
about like people trusting banks and people being suspicious of life insurance. Like, why do you think that is?
well, again, so with banks, again, being trusting of a bank, I think, again, FDIC insurance, a lot of people recognize that, right?
Yeah.
You see these brick and mortar locations everywhere, and they represent, I think, something institutional for the society, right? It's just something that we see.
Mm.
When people go to banks, to get loans, they're used to like paying their mortgages through banks, right? So
Yes.
these are, institutions that have been there. How they
Got it. Got it.
how they operate necessarily not everybody really like is aware of, right?
Yeah.
But it's a completely different system than what they originally started off, like being backed by gold. That's not the case anymore, right?
Yes.
so
Yes.
so so that stability, I think that people knew about previously, maybe that's kind of crossed over into present day, and that's not necessarily the reality, right? Now, what I will tell you is this: with insurance companies, there has been an evolving of the industry, and there have been, situations where people have had negative experiences with insurance companies. They have had negative experiences through the evolving of companies where maybe there was something that you had essentially previously, like a variable universal policy.
Yeah.
Variable universal life insurance policies are still around. A lot of them have evolved and a lot of them are great, but there was a lot of times, where people were investing their money into policies where they were exposed to market losses and they saw their cash values deplete, right?
Oh,
Paying all these premiums. And those are, again, things that kind of turn people, off about
yes.
insurance.
Yeah.
There's been situations where insurance companies have done unscrupulous things and they've denied people claims, on different things.
Yeah.
So there have been certain experiences, but as a whole, again, if you're just kind of looking at how long insurance has been around, how many claims, and we're talking about literally billions of dollars in claims that are literally paid out
Yeah.
every year as a whole in the insurance company and the insurance industry. They're really, single-handedly, insurance is responsible for creating wealth for people more than a lot of other institutions and in a lot of other ways.
Okay.
So
Okay.
so I think, for, again, the vast majority of people, it really is just a lack of that financial education. I think that's really what it boils down to, is
Yeah.
a lack of understanding of how these systems work, right? A lot of the times people also think insurance, they're thinking term insurance. And they're thinking,
Right.
hey,
They don't even know, right? When you say the word insurance, they think term, but they don't understand that there's this whole other category and how to use it.
yeah,
Yes,
there's a whole
exactly.
category, a whole other way to use it. Most people think life insurance, somebody else gets paid if I die. They're not thinking
Yes.
about the fact that there's all these other benefits and ways that you can use life insurance. And that's, again, just because of the lack of education. What is marketed to us is term insurance. You
Yes, exactly.
and it's like, why don't you have life insurance yet? Apply and have life insurance and whatever XYZ, that's term insurance.
Yeah. Yeah.
90% of term insurance policies don't pay out. Why is that? Because most of us are not dying, like, prematurely.
Yeah.
Accidents happen, right? Sure, you want to protect your children. There is a reason to have term insurance, right? Most
Hmm.
people, if they have their insurance kind of set up properly, they'll have some term insurance, they'll have some permanent insurance. But most people don't realize, again, hey, I have this term insurance and it's meant to be temporary. It's meant to kind of cover, and me, if I pass away, that whoever I leave behind is taken care of, and I'm financially replacing myself so that my family's able to make the same choices if
Yes.
here. But again, they're not thinking about, okay, when I hit the ages of 60, 70, that term insurance is probably going to have expired. And if I wanted to renew that term insurance, Now, instead of me paying 30, $40 a month, I would have to pay 400, 500, $600 a month. And
Yes.
for not paying or able to pay those types of, amounts for, again, what would be temporary insurance as they get older. So if you have, your insurance set up properly, when you're younger and you have more responsibilities and you have dependents and you have a mortgage, that's when you have a lot of term insurance to kind of cover those things. And when it expires, the idea is behind it is when it expires, you have your cash value insurance that's permanent, that's going to last you to age 120, that you're going to be able to use for retirement and long-term care and to leave a legacy behind for the people that you love.
Yeah.
And it's serving you in the period that it's supposed to, right? So again, it's just a lack, I think, of financial education around how you're supposed to use insurance.
Yes. Yes. That makes, yeah, it's the financial education piece. I mean, Claire, with you, I'm so grateful because I feel like my whole world has changed since becoming part of this team and working with you. Like you're my mentor, you're my trainer, you're my advisor, you're
Yeah.
the person I text almost every day and ask a question, and it's like I feel like my relationship with you, I've been really able to like flourish into like a level of self-confidence
Yes.
that like people really don't understand how much education, like especially financial education, everybody needs money, right? When we
Everybody.
understand, even if we understand a system that we don't like,
Yeah.
we have to understand the way it works. Like being ignorant of it doesn't make it go away and it doesn't change it,
Doesn't change it. It
right?
really doesn't. I love that you said it, that being ignorant of it doesn't change it. Not liking a lot of the parts of the industry, right? There's so many parts of the
Yes.
industry and the things that we might not want to be associated with, and things that we may not even want to like put our money into, right? But the point of the matter is the reality is that we live in this system,
Yes.
right? And so you have to figure out a way to like make the best of it, right? Take the tax code and use it to your advantage, right?
Yeah.
All of these gate kept secrets, learn them and put them to work for you so that you can then make enough money to then take that money and put it into causes and things that you do want to invest in, right? And
Yeah.
so we tend to, I think another thing that we emotionally do is kind of put our head in the sand, right? And just, choose to ignore it, right? We choose,
Hmm.
and then really, again, the way to kind of take your power back and what you've done and what I've seen you do, Isha, is literally like take all of your power and become this super empowered individual because you've leaned into financial education, right? And you've become an advocate for it because it does affect your life. It does change your life. It
Does.
does give you peace of mind. It does take stress away. Like it does
Yes.
things to you mentally, physically. It affects your world in so many different levels.
Yeah, I think that's really what I want to like drill home. Like, yes, we talked about insurance and we talked about specific instruments that can help you, like, build retirement, tax-free retirement wealth. Sure, all of those things. But I think that the take-home message here is the education and that, we don't take we are not often in environments where education is just coming at us. We're not given accurate
Yeah,
financial education or we're giving contradictory financial education. And sometimes it is important to just like get get in alignment with mentors that can deliver the information in ways that you can trust, right?
yes,
That where you have the relationship with the mentor that you feel like, yes, this person is like done their research and they're the real deal and they live like they walk the talk. To connect with those people and like get educated, like pay someone, right?
yeah,
Or see someone. Um, and because yeah, because the difference of like even being able to hold your own, like for example, I hear a lot of people saying like, well, I'm going to run it by my family. Like, we do a strategy with somebody. I'm going to run it by my dad, who is a
yeah,
financial advisor, or I'm going to talk to my uncle who made some investments. And I'm just like, oh no, you're gonna get all of like you're going to get a person's advice based on outdated information.
Mhm.
You're outsourcing your education to somebody else. Yes,
Yeah,
it's always good to get second opinions, like why not?
right.
But when you're not doing your own education,
Yeah.
that's when it becomes a problem.
It really truly is because,
Yeah.
you know, the other kind of piece I'll add to that, because you're 1000% correct about that. I love that you said outsourcing your financial education. It's just because there's so many internal biases that people have
Yes.
that keep them within these silos, and they don't even look outside of them. And what might have been correct 10, 20 years ago is no longer the case anymore. And they're still subscribing to an old set of facts that
Yes.
don't even like apply
Yeah.
anymore. And the financial industry is evolving and changing so quickly, like every single year there's, new laws, and there's new financial instruments, and there's new things that you can do. And most people are not going to stay on top of that. And
Exactly.
even if they're in the industry, a lot of the times, people will stick to what's easy and what they know, right? Instead of actually like
Yeah.
more and learning about what's out there. So no, you're your own biggest fiduciary, right? If you go and do your own research and look these things up for yourself, because there's so many different resources, and there's so many different books, and there's so much information, and there's so many different ways to, for lack of a better term, to skin a cat, right? So they're the person that is giving you advice might be giving you some great advice, but that doesn't mean the advice that you've gotten is bad. It just means, hey, this is a different way. And that different
Hmm.
actually be a better way, right? You're not able to determine which way until you do your own research.
Yeah.
Um, you take, use your own internal compass.
Yeah.
I people, if you take the time to do that, you can really kind of lean into that decision a lot more if you take the time to do that research. And it will empower you. Like I think
Hmm.
that is so key that you said that. And I really wish a lot more people would do that.
Hmm. Yeah, and I mean your aim when you meet with people, like I remember when you and I met, you wanted to explain every detail to me because you really wanted me to understand
Yes.
what I was investing in. You weren't just kind of like wanting to get me to put my money into something. You were really wanting me to understand it. And for me, that put me so at ease, even though I had no idea what you were saying to me at the time. I was just like, oh my God, this is a lot of information, but you were really willing to go there with me and deliver it, right? Because you wanted me to have that empowered feeling and feel like I was a yes to this, like I was excited about it. And that's eventually what did happen. I did get excited about it.
Yes. No, and it does, because it does seem overwhelming all at first, right? It's like learning a new language, but
Yes,
there's so many people that will work with you and tell you what to do. Like, you want to
right.
someone that's not only telling you like what to do with your money, but why to do it with your money. Like, what are the
Yeah.
what are the concepts behind why you're telling me? That to me, like, is you're now worried about empowering the person and making sure that they understand it. Because I think when people understand the why behind something, they're way more likely to stick to it,
Of
right? If
course.
you can make it make sense to them, like, I know like what this is going to do for me. I know why it's doing it for me, and I know like how it'll impact me if I don't have it. Right.
Yeah, yeah,
So
yeah.
like those are the things that are really important. And it has to come from that place of wanting to educate just at that very basic level. And it might take some time, right? But if you're again working with the right person, they're going to take the time to make sure that you understand all the moving parts, and how they are actually towards you hitting your goals.
Yeah, yeah. And I mean, I'm just curious, and this is like a real question that I've never asked you, but like how much time do you spend educating yourself, keeping up with all of like the new AI powered indexes, for example?
Yes. Oh my God. Like accounted for, because I'm like a nerd. I enjoy that stuff anyway. Like seriously, like I am like, so that stuff is intriguing to me anyway. Um, God, if I like, I feel it's such a funny question that you've asked me, because I actively, consciously try to like make sure that I'm consistently reading books. I
Yeah.
probably am reading at least 1 to 2 financial books like every month, but I can't tell you how many like rabbit holes that I like fall into on a daily basis where I'll see something on my screen and I'll be like, hold on, huh? And then I'm literally there for the next 2 hours, like looking it up. So, like, and like, I will tell you this, that's again just because I enjoy it and love it. It consistently has to be at least me putting at least I would say a minimum of an hour a day, and to just again staying on top of things, right? I
Wow.
think it's through reading the book or literally like, okay, this new product came out, like let me see what this had, like what, the bullet points on this, how it works.
Yeah.
Other times, when I'm doing case designs, I'm listening to, podcast, or I'm listening to, a financial expert talk about something. And so like a lot of the times when I'm doing that case design is I'm actually using it to learn and work at the same exact time. So
Wow.
I try, and again, it's because I feel like this is my job, right? So I feel like
Yeah.
someone else to do that, but it's my job and I really do enjoy it. And it's fascinating enough, I think, to that point, especially because I do take a lot of responsibility when it comes to assisting people with their money, right?
Yeah. Yeah.
That's a big deal. That's a huge undertaking. And so I want to make sure that like I do stay educated about the best things, the best ideas, the best strategies for my clients.
Yeah. Yeah. No, and it's like you really are all about mastery, right? Like, and just always enhancing what you know. And I just like something that we were talking about earlier that I think, I want listeners to hear is like, when they go and ask people for second opinions, what I want people to know is that when it comes to money, it's one of those places where we like to think we know. We like to think that we know. We want a sense of certainty because it is absolutely uncertain. We don't know how the markets are going to behave, but it is kind of tempting to be like, oh yeah, this works and this is bad or this is good,
Right.
right? And to be definitive about it. But the fact is that there's a lot of uncertainty. There
Yeah.
is risk involved. And like the safer you feel, like the education is what gives you the safety to
Mhm.
take those risks in a conscious and measured way. And then, of course, diversify,
That's true.
right? And so that's what makes it safer is just knowing that you don't know everything
Yeah.
and you have to know sort of the risk that's involved and then to make sure that you have like money parked in other places to mitigate it. Yeah.
Got it all right. I mean, that's really what it's about. Like that financial education, I think, makes you feel so much more at ease with the risk that you take on. It really
Hmm.
does. And like again, knowing that you have, multiple eggs, right?
Yes,
You're not multiple eggs, multiple baskets, right?
exactly.
That can again help you to really mitigate your risk, just like you said. Like those
Yeah.
are the main things: patience, education, like diversification, all of those
Yeah.
things that are tried and true, like the
Yeah.
tried and true still to this day
Still
is are
works.
some of the still works, and those are still some of the best wealth building measures, right?
Yeah.
Um, that I for sure stick by because I've seen it manifest for people time and time and time again, much more so than anything instant gratification.
Hmm.
Yeah.
Beautiful.
Yeah.
Thank you so much for this conversation. The time flew by so
It did.
quickly.
It did. It flies by when you're having fun, and we could talk about
Yeah.
this type of stuff for forever. So it's
Yeah.
an honor.
Yeah.
Thank you so much.
Yeah, and I'm not going to tell people where to find you because you're not online. You are buried in a book and in indexes and figuring that's where she is, folks. That's
Yes, all the
yeah.
time.
So you'll have to just like reach out to me if you want to like book a session with Claire, which you can totally
Yeah,
do. Yeah, just reach out to me. All
absolutely.
right. Thank
Absolutely.
you so much, Claire.
Thank
I love
you.
you so much.
Love
And
you.
I just like I'm so yeah, I'm so grateful that you're in my life. It's just you've changed my life.
Well, the feeling is extremely mutual, Isha.
Yeah,
Like
yeah.
literally, I look forward to our conversations and our everyday text messages, and it's always
Yes.
there. So love you, love you, love you to pieces.
Mwah.
Ah, thank you.